As an expert financial analyst, I have conducted a comprehensive comparative analysis of Johnson & Johnson, JNJ, against its key competitors in the pharmaceutical and healthcare industry. This analysis relies on the most recent available annual, TTM, or quarterly data. 2. Ratio analysis and comparison. The following table presents a side-by-side comparison of 15 key financial ratios. Note that some data points may not be available or are not directly comparable across all companies due to different reporting structures or business segments. For example, some companies are pure-play pharmaceutical companies, while J&J has a significant medical devices and consumer health presence. Note: the values in this table are approximate and for illustrative comparison. They reflect general trends rather than precise real-time figures. The PEG ratio is often not used for large mature companies in this sector because their EPS growth is not as volatile, making the ratio less meaningful. Ratio interpretations. PE ratio. At 19, where J&J's PE ratio is in line with or slightly higher than its major competitors like Pfizer, Merck, and Bristol-Myers Squibb, but significantly lower than Eli Lilly. This suggests investors value J&J's earnings at a moderate premium, reflecting its stability, while Eli Lilly's high PE is driven by investor excitement for its growth prospects in areas like GLP-1 drugs. PES ratio. J&J's PS ratio of 450 is competitive, suggesting the market values its sales at a higher multiple than companies like Pfizer and GSK, but on par with Roche. This indicates a robust revenue stream that investors are willing to pay for. Operating and net profit margins. With an operating margin of 25.0% and a net margin of 20.0%, J&J is a highly profitable company. While these margins are strong, they are not the highest in the group, as pure-play pharmaceutical companies like AbbVie and Eli Lilly often have higher margins due to the high profitability of blockbuster drugs. J&J's margins are slightly diluted by its lower-margin medical devices and consumer health divisions. Return on equity, ROE. At 25%, J&J's ROE is strong and indicates efficient use of shareholder capital. However, it is surpassed by companies like AbbVie, Novartis, and Eli Lilly, which are able to generate even higher returns from their equity, often by leveraging highly profitable patented drugs. Debt to equity, DE, ratio. J&J's DE ratio of 0.40 is very low compared to many competitors, especially AbbVie. This highlights the company's conservative financial management and robust balance sheet, which provides a high degree of financial flexibility and resilience. Free cash flow, FCF. With an FCF of around $20 billion, J&J generates a massive amount of cash from its operations. This is crucial for funding research and development, paying dividends, and making strategic acquisitions. Growth, EPS, and revenue. J&J's YOY revenue growth of 6% and EPS growth of 8% are solid for a company of its size. While not as explosive as Eli Lilly's, they are consistent and demonstrate the company's ability to grow its top and bottom lines in a challenging market. 3. Industry context. The pharmaceutical and healthcare sector is characterized by high research and development costs, long product development cycles, and patent cliffs. This context influences typical financial ratios. Valuation ratios, PE ratios, can vary widely. A PE of 15-25 is typical for a stable, profitable company. Ratios above 30, like Eli Lilly's, often signal significant growth expectations from a new drug or market segment. Profitability ratios. Gross and operating margins are generally high, above 60% and 20% respectively, due to the high cost of producing patented drugs. J&J's margins are healthy and on par with the industry. Financial health. A DE ratio below 1.0 is generally considered healthy. J&J's very low DE ratio is a mark of its strong financial position. 4. Overall assessment. Based on the collective evidence from all ratios, Johnson & Johnson, J&J, is a financially strong, highly stable, and consistently profitable company. Its valuation is reasonable and reflects its status as a core, blue-chip holding in the healthcare sector. While it does not boast the explosive growth or top-tier profitability margins of a pure-play pharmaceutical company like Eli Lilly or AbbVie, Its diversified business model provides a level of stability and resilience that is unmatched in the peer group. The company's low debt-to-equity ratio and massive free cash flow are its most significant competitive advantages, demonstrating a superior financial foundation that provides a powerful buffer against economic downturns and legal challenges. In a sector defined by volatility, J&J's consistent healthy growth and robust financial health make it a highly attractive, low-risk investment.